This is Create the Next from Pro CFO Partners, where every week we explore strategies and ideas for financial management and growth to help today's businesses put their financial picture in context.
Welcome back to Create the Next. I'm Chris Mitliff, and Joe Briner is with us today. And Joe, I'm really glad to be with you today. I'm really glad to have this conversation because you wear many hats of expertise. You have an illustrious history of finance genius behind you. And I think we can tap into that today to talk a little bit about raising capital. And my understanding is you've been the CEO of a bank. You've been an investment banker. Here you are CFO. Let's talk a little bit about each of those. Just kind of what's your experience with those things? What have you been doing? Because I really want to start to dig into what are each of those sort of personalities and personas and responsibilities looking for in this space of raising capital. So welcome. Give us a little bit about you.
Sure. So as you said, I'm a recovering banker. I'm an investment banker and CFO. And so one of the things I thought would be most interesting is kind of diving right in on the differences. We talked about the three different lenses, if you will, that you can look at a potential financing opportunity. And as a president of a bank, banks do not take risk. People think, it's not a big risk. The bank, no, that bankers are risk averse. And the reason is they operate on razor thin margins. So they operate on 2% margins. So think about that. You can't take losses. Banks do not want to take losses. Their number one concern is getting paid back. When you go to a bank seeking capital, their number one concern is, will I get my money back? If they aren't convinced 100% that they will get their money back with a little bit of interest, then they don't move forward. And that's quite a bit different. A CFO is going to be looking at it differently. He's going to be planning the capital needs of a business. He's going to be looking for strategically, what's the right time, what's the right mixture, the right type of financing to get? Is it going to be dilutive? How does it fit with our long-term strategies and goals? And so totally different lens for a CFO. And then, of course, an investment banker is looking at it, well, what's the most we can put into this thing? What's the most capital we can raise? What's the biggest swing for the fences? I'm being a little bit overly simplistic. But actually, investment bankers have a good discipline process. They want to underwrite it. They want to get the deal done. So they want to look at it the way the markets are going to look at it. And sometimes there are debt capital markets. Sometimes there are equity capital markets, and there's hybrid as well. So each one of these players brings their perspective, their lens to the process. And, an effective CFO is able to understand and stand in the shoes, really, of the different participants and speak their language and approach it from their perspective so that as questions come up and as deals come together, they've already thought it through, it already fits, and it's just a matter of showing the other participants how it all works and why it's in their best interest to move forward.
This is fascinating to me, and it always has been because especially in small and mid-market, if you're a founder, if you're an executive, if you've been there a minute and you've kind of got a team of leaders around you, it might be different, but we can come into these things with some emotion. We can come in like, well, I really believe in this business. I've got a vision. It's amazing. I can't wait to share it with everybody. And what I hear you saying is, yeah, that's cool, but they don't really care. And this is where the value of a CFO, as you pointed out, who can sit in those shoes, seems to me to be indispensable. Like, let me distill your vision, because you don't want to lose that, right? You don't want to lose that, the thing that makes you excited about going to work. But how do we package that in a way that this person sees the story the way that we want them to read it? Do you feel like there's a story to be told and the CFO kind of has to figure out which language to tell it in?
That's exactly it. People are hardwired for stories. And so they do like the story. CFOs tend to deliver facts and graphs and charts and projections, but connecting on a personal level with the story and so that they see the passion and behind it, they can see that you've done your homework and you've got a solid business plan. But absolutely, and that goes for everyone really. In the capital markets, as an investment banker, you can tell the difference between somebody that has an idea and isn't really behind it and somebody that has an idea and it has fully supported it. They're fully engaged with it in every way. And so you're looking for that. You're looking for, and the banks call it, there are 5 C's of banking or of lending. Character is typically character or capacity is number one on everyone's list. So the character of the individual, capacity of course to repay, the conditions or covenants, the collateral, the capital. So banks look at it that way, but when it comes to the the personal connection and the story, everyone wants to see a nice cohesive plan, and they want to see the personalities, and they want to be able to report back to their superiors. We all have superiors that, hey, I've checked this out from every angle, and I think that this is a good opportunity for us to put some capital into.
It's really interesting that character is number one in there. As you, I guess, from your experience in banking leadership, how does that shape the approach you take as a CFO when you're working with your clients or pro CFO partners, clients? How does that help you to? I can only imagine it's just like, well, I have the cheat code, everybody, but how do you approach the problems with such a breadth of awareness?
Well, something you hinted at there. I have a rule that I follow, and that is you can't turn a bad client into a good client. So no matter who it is, if somebody has a track record of destruction or heavy litigation, that's going to be hard to overcome. But when it comes down to finding the right personalities, life is short, and I'm very fortunate in that I get to pick the people I work with. I get to work with people who do have passion, who have integrity. And I can tell very quickly, having been on the planet for 6 decades, that if you don't have that, it comes out pretty quickly. And there's an opportunity for any client to work with somebody, but sometimes it's just not me, because I want to focus on people that I can genuinely help, that I know work the way I do, which is all cards on the desk, face up all the time. That's the only way to do business, especially when you're dealing with bankers and capital markets, because they will find out, and they will be very unforgiving for anything that wasn't fully disclosed and known and checked off during the process.
Interesting. Transparency, obviously you would think, but it's a crucial point of view. Are there 5 C's, something similar for investment banking? Is character number one on that list, or is it very much we really want a gut feel for the possibilities for business and what's 3 years from now look like and things like that?
In the investment banking world, the lens is going to be a little bit different, right? So in the investment banking world, valuation is kind of king. Mm-hmm. You have to make sure that the valuation lines up with what the company needs to accomplish. If that unfortunately does not start with a C, I don't think. I think it starts with a V. But no, if the valuation doesn't line up, then you've got a fundamental mismatch at the very beginning. Now, character is still very critical. In general, just people stay away from those caustic, personalities out there. Again, there's a place for them, and they'll find the right provider. But it helps if you've got a sterling reputation, and if you disclose, hey, you know what, I had some hiccups during the Great Recession, or our company, hit an enormous challenge with IP infraction, or whatever it is. As long as it's disclosed, again, the markets are forgiving if you tell people on the front end. But bankers, whether they're investment bankers or commercial bankers, hate surprises. So no surprises. All cards face up all the time.
Nelson and I have talked about how a way to think about things is to act like you're going to sell your business tomorrow. And therefore, you will always have your ducks in a row. You'll have your reporting on point. You'll know all the information. And that puts you in a position of power, because you can quickly move in any direction and be ready to talk to an investment banker, talk to the banker, whatever. Do you find, especially in this small to mid market, is there a if I could tell everybody one thing, it would be like in my mind, it's you have to be better prepared. I see too many people who are coming in without the right this or without the right that, or it's too early or whatever. Is there one thing? There's many, I'm sure, but is there one thing that seems to come up again and again and again?
One thing I do see quite a bit is for example, I'm a mentor at Tech Alpharetta here in the city of Alpharetta. And I see a lot of very early business plans where people are very passionate, but there's just not, they're early. They're a person with a plan as opposed to a history of operations. So I do see a lot of early stage companies, and it takes a lot of work to build the entire platform for a successful company. It just takes time. When I started my bank, it takes over a year to get all the information together, go through some very rigorous questioning with the regulatory authorities, and most businesses aren't that disciplined and methodical when they start. So there are resources that you can go to. You can go to your local tech incubator. We have ATDC here in the city of Atlanta that does a phenomenal job. So there are resources. I would say seek out those resources. Ask competent financial advisors for guidance on what they need to be doing in order to position their company for that next stage or transition, whatever it might be. Most of the time, though, Chris, it's just they haven't thought it through. They haven't planned, so a lot of things catch them by surprise, and so we do see that a lot. Usually, it's salvageable. Sometimes, it takes a lot of work to do. So I've done a lot of turnaround, distressed, recapitalization, restructuring work. That's a very heavy lift. If you can get to financial guidance, good, competent financial guidance before that, you can save yourself a lot of time and money and heartache.
Do you have a sense for what the mood for capital is out there right now? There's so much going on. We've got tariffs reality. That's a new thing for many people. We've got a lot of different uncertainties. How's it going? Like, what's the mood? What's the climate? Are banks feeling good? Not feeling pretty? We're going to be pretty. Are investment bankers excited? Are they kind of, what are you seeing?
So that's a great question, and we're going to have to edit this out, because it's going to be stale in 6 months. But
that's how these things go. That's a good point.
I'm sorry, just telling you the way it is. Markets are on edge. So ironically, every time I look at this, there's more capital available than there ever has been in human history, and that's true today as it was. I've written blogs on this a few times. So it's not an availability of capital; it's that capital. It goes through cycles, and we're in a cycle right now where it is very cautious, where a lot of the funds, if you will, private equity in particular, they seem to be holding the reins pretty tight because they don't know what's going to happen geopolitically and tariffs and all the different things. But I look back over history, over a 40-year career, and there is always, they call it a Godot recession right now. There's a play called Waiting for Godot, where Godot never shows up. Well, it's a Godot recession. People have been saying for 10 years we're going to have a recession, but it hasn't shown up. So there are always things on the horizon that capture attention and create caution. This time you hit on a couple of the things that are causing that, but there's more capital available. I do see, banks are doing good, prudent loans right now. They've gone through cycles where they shut down completely, but I think that for them, it's a pretty good cycle to be in right now, where capital is available. Most companies are performing really well. That's the number one thing for banks. Again, they have to make sure their money comes back. So, right now, it's a challenging environment. I'll say this: deals that we typically have gotten done, pretty quickly, and if you're doing capital markets transaction, that's 4 to 6 months. It can take 9 to 10 months, so that the timing is longer. I think everyone's putting a lot more effort into due diligence. And the big thing driving that is that private equity just hasn't had the exits opening for them that they normally have. The IPO market has not been very strong. Bigger funds are not buying the assets from smaller funds. So you're seeing a lot of continuation vehicles, secondaries, net asset value loans. A year ago, we worked with the London Stock Exchange when they were opening their secondaries platform called Pisces. Really cool platform where private equity firms can put a chunk of their private equity platform investments shares available for sale, so the people, the LPs and investors that want liquidity can get it. So we're seeing a lot of things like that. It's a different market. It hasn't quite found its footing yet, but the bottom line is people like us have to show up to work every day. We have to look at what our capital needs are going to be from a CFO lens. We have to look at that. We have to make sure we're planning accordingly. We need to know what our cost of fund, availability of funds is going to be, how long it's going to take to get it if we need it. And if we're looking at a big transaction of some kind, make sure that our capital providers know about it well in advance so that we aren't in a position where we've overcommitted or we don't have the liquidity we need to make something happen that is part of our that's mission critical core to our plan.
As a CFO, is that kind of energizing for you? Like when we're in a dynamic or sort of curious era like this, do you kind of get to flex some different muscles and really get creative with how you're thinking about this? Or what if we kind of position it to tell the story, for instance, in this way? Is when all of these different sort of cycles over 40 years, do you get to find new ways to tell the same story?
Well, it's always a different story because at times, no two events are identical in capital markets and in the life of a business. So it is exciting for somebody like me. I've got a unusually broad range of experience. So CFO is part of that. But having been very deep in the commercial banking side of things and very deep in the investment banking side of things, positions me to have kind of finger on the pulse and be able to guide companies appropriately so that they don't fail to plan. That's the biggest thing. If we can help companies have a good, solid plan and give them, enable them to see a little bit farther down the runway, maybe look around a corner or two that they aren't familiar with, a good CFO can really help a company thrive no matter what the conditions. Markets come, markets go, cycles come, they go, but a good CFO will help that business set the right strategy and implement it correctly and make sure it's funded correctly with the right financing tools.
We say this phrase sometimes, the right CFO. From your perspective, what's the wrong CFO? Like what are some characteristics that if I'm a business leader and I'm consistently seeing that I don't have this kind of guidance behind me, I don't know, what are some of the symptoms of you might need to rethink how you're approaching this problem?
That's a very good question. In fact, I had experience with this. So back during the recession, I did have a CFO who would literally be shaking. He'd have a report and would be shaking. We were on uncharted waters. The Fed had raised rates 17 straight times, and everyone thought the sky was falling. You can't panic. You have to. Your CFO has to have a good command of the business, what's going on, all the pieces. Make sure that all the reporting is as stout as it can be, and that if there are cracks developing, that they identify it. But it's useless just to identify because anyone can say, "Oh, I think that's a crack." Come up with a solution. Bring 2 or 3 solutions, even better, so that the business isn't just you aren't just dumping everything on the CEO's desk and saying, "This is a problem. You got to fix it."
Right.
CFOs need to be problem solvers. They need to. The first word is chief, right? You're one of the primary executives of the business. Your job is not to just report or spot problems or make sure compliance. Yes, you have to make sure compliance is jam up. But when you identify a problem, you have to communicate it clearly and do some analysis and bring a solution. That's the value that a good CFO will bring. They won't just sit back and clock out at 4:30 on Friday and think everything's great. They'll put in the appropriate time and they will identify when things are going off track, why and how to fix it, And if you've got one that's got some experience, they'll also say, I've been through this. Here's what we do. Here's how we get through this next big wave. And keep the ship steady.
Joe Briner is among our experts at Pro CFO Partners. Joe, this has been great. Come back soon. I feel like we could have a conversation on each of these three things, but also just new ideas come to mind for me as you're talking, as you're sharing, and I'd love to pick your brain about this stuff. Thanks so much for joining us today. You've been really generous with your expertise. Appreciate it.
Thanks, Chris. Look forward to it.
Thanks for watching, and a special thanks to our subscribers. Consider becoming one today. Visit ProCFOPartners.com for more strategies and ideas for financial management and growth to help you put your business's financial picture in context.